Hey everyone, and welcome! Today we're going to pull back the curtain on a financial product that's a big deal here in Malaysia, Islamic personal financing. We're going to break down exactly what it is, how it actually works, and what really makes it so different from a regular old loan. So let's say you've got a big life goal on the horizon. Maybe you're looking to fund your education, finally get that home renovation done, or maybe just get all your debts in one place to make life easier. For most people, the first thought is personal loan, right? But what if you're looking for a path that aligns with your personal principles? A way to get the money you need, but without getting tangled up in a traditional interest-based loan, what's known in Islamic finance as riba. So is that even possible? Getting financing without interest? Well, the answer is a big yes. There's a totally established Sharia-compliant system designed to do exactly that. And that just means it follows Islamic ethical rules, which strictly forbid charging interest. And here is the absolute key difference. Islamic personal financing isn't actually a loan. At its heart, it's a way to get you cash by using a series of trades. The bottom line is this: the bank makes its money from the profit on a sale, not by charging you interest on borrowed cash. And the main financial engine that makes this all happen, the one used by pretty much every Islamic bank in Malaysia, is a concept called tawarruk. You might also hear it called commodity murabaha. Now, I know tawarruk sounds kind of complicated, right? But honestly, it's just a series of trades, one after the other. So let's peel back the layers and see exactly how this process creates cash for you step by step. All right, let's walk through it. It starts off familiar. You apply for the financing, and the bank gives you the green light. But this is where things get interesting. The bank then goes out and buys a real, tangible commodity. We're talking something like crude palm oil from the open market. Then, in the next step, the bank sells that exact same commodity to you, but at a higher price that you both agree on. That markup is the bank's profit, which you'll pay back in installments. But of course, you need cash, not palm oil. So you immediately give the bank permission to sell that commodity for you. And voila, the cash from that final sale is sent straight to your bank account. Now, this step right here is absolutely critical. When the bank sells that commodity to you, a real binding sales contract is drawn up. It clearly lays out the total sale price, that's the original cost plus the bank's profit, and your entire repayment schedule. See the difference? It's a trade agreement, a world away from a loan agreement. So what's the end result of all this buying and selling? You get the cash you needed. The whole system is built on the foundation of trading a real asset, which means it completely sidesteps the act of lending money for interest. Okay, so that's the theory. But how does this actually stack up in the real world, with real money? Let's dive into an example using the official numbers from an actual bank's disclosure sheet. For this, we're going to pull up an illustration right from Bank Islam's very own product disclosure sheet for their personal financing product. This way, we get a super clear, real-world picture of all the costs involved. All right, let's look at the numbers. Say you get $100,000 in financing for a 10-year term. Your monthly payment would be about $1,073. So over those 10 years, the total amount you pay back is just under $129,000. That means the bank's total profit from the whole commodity trade is $28,750.04. And the most important part? That number is laid out clear as day from the very beginning. No surprises. Of course, there are some other standard fees, like stamp duty. But I want you to look closely at that late payment charge. It's set at 1% per year, but, and this is huge, it's only on the amount that's actually overdue. It never, ever compounds. That charge doesn't get rolled into your main debt, so you avoid that dangerous debt spiral that can happen with compounding interest. Now, it's not without its risks, and they're very upfront about this. This financing is based on a floating rate, which means it can change. This chart shows you exactly what happens if the central bank's base rate goes up. A 1% jump would mean your monthly payment goes up by about RM50. A 2% jump adds about RM100. This kind of transparency about what could happen is a required part of the deal. Okay, so now that we've seen how it works and what the numbers look like, let's do a direct head-to-head comparison. Let's put Islamic financing and a conventional loan side by side to really nail down the differences. Let's start with the absolute core of each product. They're just built differently from the ground up. Islamic financing is all about a trade, a sale of a real asset. A conventional loan? It's simply about lending money. One's a transaction, the other's a loan. And that core difference changes everything about how the bank makes money. With Islamic financing, the profit is part of the sale price. It's fixed, and you know it from day one. In a conventional loan, interest is charged on whatever you still owe, and this is the real kicker, it can compound if you're late. That's how a small debt can snowball into a massive problem. And finally, let's talk about the rules. A conventional loan just has to follow the country's financial laws. Simple enough. But Islamic financing has to follow those same laws, plus an entire extra layer of Sharia principles. And there's a special Sharia advisory council that keeps an eye on everything to make sure it all stays compliant. It's an added layer of ethical oversight. All right, let's wrap this up and put a bow on it. Once you really understand these differences, you can make a much more informed choice, one that really fits not just your financial needs, but your personal values too. So when you boil it all down, what is Islamic financing really offering? Well, it's a way to get funds that completely avoids interest. It gives you total transparency on the profit from the very beginning. It protects you from spiraling debt by banning compounding late fees. And it all operates under this dual system of governance that includes a strong ethical framework. Ultimately, this all leads to one final question for you to think about. When you're looking for a financial product, what really matters most to you? Is it just the simplest process? Is it finding the absolute lowest cost no matter what? Or is it about the principles and the ethical framework behind the money? Definitely something to chew on. Thanks so much for joining me.